Good evening, everyone, and welcome. Investors had been hoping that today's retail sales report would show a rebound from the winter spending chill. It didn't. The government reported that retail sales barely budged, coming in unchanged in April. Consumer spending accounts for nearly 70% of economic activity, so many consider this report just as important in its own way as the monthly employment number. But for now, there's no sign of an economic bounce back, and that could make the Federal Reserve's decision on when to hike interest rates even more complicated. Hampton Pearson reports.
No signs of a springtime rebound in the economy from the latest retail sales numbers. The April spending downturn had several moving parts. Big ticket spending on things like autos, electronics, and furniture was down. Some strength in closing sales, which were up slightly, along with sporting goods and online stores. The biggest springtime bounce came to sales of garden equipment, building materials, restaurants, and bars, as the hibernation in many parts of the country finally ended. It's still a catch-22 for the Fed. Low rates are supposed to help spending, but consumers didn't spend in April. They didn't spend when the weather was bad in February and March, and they haven't really been spending since last fall.
Over the last 6 months, we've essentially flatlined. So monetary policy, which its intention is to drive demand, obviously has pulled forward so much economic activity over the last couple of years that there's only so much more they can pull forward.
Since spending accounts for 70% of all economic activity, slow growth is another potential speed bump for the Fed on the road to raising interest rates. And leading economists are wasting little time in lowering GDP forecasts. J.P. Morgan cut expectations for the second quarter GDP from 2.5% to 2%. Meanwhile, the snow may have melted and the backup at West Coast ports eased, but there are few signs the stronger dollar is going away anytime soon. It's already impacting the trade deficit and tourist spending, and providing more ammunition to critics of the Fed's long-running low interest rate policy.
That has limits, just like anything else does, and we're well past those limits, and we're seeing it firsthand.
What the data-dependent Fed needs to see are a return of stronger job growth and higher wages to encourage consumers to open their wallets and spend more money. For Nightly Business Report, I'm Hampton Pearson in Washington.